Warren Buffett has broken his silence, and the message he's sending is terrifying for stock market investors. We may be on the edge of a financial cliff, staring down the barrel of a lost decade, where the market delivers zero real returns for the next 10 years. You read that right, a full decade of stagnation. Now, some say Buffett's outdated, a relic of the past, a dinosaur clinging to strategies from another era. But here's the truth. Betting against Buffett has historically been one of the most expensive mistakes an investor can make. And while history doesn't always repeat itself, it often rhymes. So in this video, we're diving into Buffett's latest playbook, moves that mirror his strategy before the last lost decade, where the S&P 500 returned 0% over a 12-year stretch. We'll reveal how this exact strategy has made Buffett the only top billionaire who's actually making money in 2025. And finally, we'll break down how you, even without billions in cash, can prepare using Buffett's 2008 crash framework. Despite all the noise in the markets, Buffett has been eerily quiet, except for one massive move, Berkshire Hathaway's jaw-dropping $130 billion in stock sales. But here's the real shock. Since then, Buffett's been making his boldest move yet by doing almost nothing. And that nothing speaks louder than 1,000 trades. As of now, Berkshire Hathaway is sitting on a mountain of cash, over $347 billion, more than a third of the entire company's value, just parked, waiting. But instead of scooping up deals, Buffett is not buying stocks, not even repurchasing Berkshire's own shares. Why? Because he doesn't see value, not even in his own company. Instead, he's stashing his cash in short-term U.S. Treasuries, collecting 4 to 5% in annual yield. That alone is bringing Berkshire a cool $13 billion a year from bonds, not stocks. That's not just a strategy. That's a message. And it's a message Buffett's delivered before, right before the dot-com bubble burst. Let's rewind to 1999. Markets were on fire. Tech hype was everywhere. Valuations were out of control. Sound familiar? That year, Buffett's annual letter to shareholders, which are all publicly available, delivered a chilling warning. He said investors had become unreasonably optimistic about future returns. Stock prices had lost touch with reality. And then, he predicted something almost no one believed, that the next decade would see no meaningful returns from the stock market. He was mocked. Critics called him out of touch, too old school for the new tech age. But in 2000, the market crashed. From 2000 to 2012, stocks returned just 2% per year, less than inflation. Buffett had been right, and while others lost, Buffett won. During that lost decade, bonds and dividend stocks crushed the overall market. And what had Buffett done leading up to it? He had pulled back. He stopped buying overvalued stocks. He held cash. He refused to repurchase Berkshire shares. Exactly what he's doing today. And the parallels don't stop there. Let's look at two massive indicators. One's Buffett himself has referenced. That signal we might be in dangerous territory once again. First, the Buffett Indicator. Buffett has called this metric the single best measure of where valuations stand. It's calculated by dividing the total U.S. market cap by the GDP. In 2000, during the dot-com bubble, this hit 140%. In 2007, before the Great Recession, it spiked again. In 2021, another massive market surge. And guess where we are now? 177%. The highest in modern history. This suggests the market is massively overvalued, just like in the past before major crashes. Second, the CAPE ratio, also known as the Shiller PE, named after Nobel laureate Robert Shiller. It measures stock prices versus average earnings over the past 10 years. Historically, when this number is above 16, markets are in bubble territory. Before the 1929 crash, spiked. Before the dot-com crash, same. 2008, elevated again. And today, roughly 33, double the historic average. Two red flags, both screaming the same warning, correction ahead. Now sure, we've already seen some pullbacks. CNN says the market isn't in a hype cycle, maybe even a bit fearful. But the numbers don't lie. Despite investor anxiety, valuations remain sky high. So what gives? Well, this isn't just about numbers. It's about psychology. Buffett explained it perfectly in 1999, using the metaphor of Cinderella at the ball. He wrote, "The line separating investment and speculation becomes blurred when investors have recently enjoyed triumphs. After a heady experience, normally sensible people act like Cinderella at the ball. They know staying too long will turn things into pumpkins and mice. But no one wants to leave the party early. The problem? They're dancing in a room where the clocks have no hands. That's where we are now. Everyone knows this can't last, but no one wants to be the first to walk out the door. Except Buffett. He's not even in the ballroom. He's waiting, watching, stacking cash, just like he did before 2008. So what exactly is his playbook when markets look this dangerous? Let's break it down. First, a common myth that Buffett never times the market. He said himself that market timing is both impossible and stupid. And maybe he doesn't time the market in the traditional sense, but he absolutely changes his behavior based on data. Let's go back to 2008, the last major crash. Buffett was once again sitting on billions in cash. And right when panic peaked, he moved fast. He poured $20 billion into beaten-down businesses, including a major bet on Goldman Sachs. That one move earned him massive profits while everyone else was drowning. He even published an op-ed at the time, "Buy American, I am." So what can we learn from that? First, patience. Buffett doesn't rush into hype, he waits for opportunity. Second, liquidity. When the crash comes, cash is king. Third, confidence. When great businesses are on sale, he doesn't hesitate. And that brings us to your strategy. No, you don't have billions, but you can follow the framework. Stay consistent with your investments. Build a cash reserve. Increase your income so you can invest more when the time comes. So let's bring this full circle. Buffett may be quiet, but he's speaking volumes with his actions. He's not chasing hype. He's not throwing cash at overpriced stocks. He's parking money in safe assets, waiting for the moment when fear creates opportunity. And when that moment comes, he'll be ready. Will you? Stay sharp, stay patient, and whatever you do, don't bet against Buffett. If you found this video eye-opening, make sure to hit that like button, subscribe, and turn on notifications so you never miss a move from the world's smartest investors. Your financial future may depend on it.